Growth stocks are stocks that are growing at an above average rate compared to other stocks in the market. Growth investors are investors who predominantly invest in growth stocks because of that promised growth and the promised outcome at a future date. And they're equally prone to mistakes, in the course of their investing in these classes of stocks. And so I want to examine the different kind of mistakes growth investors are prone to make and how to avoid them. Number one, overvalued stocks. Overvalued stocks. Growth investors tend to invest in stocks that are classified or considered overvalued. Overvalued in the sense that when we look at the actual financial metrics, so you discover that the stock involved is actually priced at a very high price compared to other stocks in the market. Number two, high volatility. Growth stocks are known to be volatile. They most of the times undertake price swings that can take the stock upward, and that can equally bring the stock price downward. And whenever this particular phenomenon occurs in the market, you discover that growth investors tend to have sleepless nights and may be prone to making decisions that are not based on logic or reason. They may decide to sell out to the markets, probably at a price they wouldn't really want to sell because they can no longer stomach the level of volatility the stocks are undergoing. And that's why, as a growth investor, it's advisable that you diversify away from growth stocks. Buy other kinds of stocks so that should in case these are price swing occurs, a downward price swing occurs in growth stocks, you have a level of safety. Number three, neglecting fundamentals. Growth investors are known to neglect fundamentals of companies. Fundamentals like like the debt level of a company, like the company financials, like the balance sheet strength. All these things, growth investors tend to neglect them. They concentrate solely on the price movements, which of course is not the right thing to be done. As a growth investor, it's advisable that as you're investing on growth, don't neglect the fundamentals of this company. Talk about their debt level, talk about their cash flow, and talk about the strength of the balance sheet. These fundamental metrics should not be neglected, or else it might result in something that's not palatable. When it comes to returns, the investor is likely to accumulate. Number four, short-term focus. Growth investors tends to focus on the short term. They buy with a belief that the stock is going to climb very high in the next 3-6 months to a year, which ought not to be so. That as an investor, one should have a long-term horizon in mind. But unfortunately, growth investors, they tend to invest, for the short term, trying to capitalize on the short-term growth a stock is likely to undergo, which of course is not a right kind of investing. One should not adopt that strategy at all. If one must adopt it, it should be mixed with other strategies that will give you a more balanced portfolio. Number five, lack of diversification. Growth investors tend to concentrate their holdings, in a few sectors or in a few securities that are growing at an above average rate, which is not what should be expected of an investor. Despite the fact that the stocks are growing, you should try to diversify, in different sectors, spread your risks into different industries. And if possible, you can also diversify across region so that should in case a given sector or a given industry is not doing very well, it will not affect your overall portfolio return. Number six, increased risk of loss. Increased risk of loss. Growth stocks actually growth investors are known to be almost like they invest like speculators. They invest with the belief and opinion that a growing stock will continue to grow, almost to the sky, which of course the reality is far from that particular opinion. The stocks cannot grow forever. And whenever this stock, for one reason or the other, stop growing, you discover that the stock will take a downward trend, and an investor is likely to lose its money, to lose his funds, to lose his capital in that regards. And so it's almost like it's more of speculation compared to a strategy like value investing. And so the risk level involved in a growth investing is relatively high compared to other strategies. And so what do you do in this regards? You tend to like that you are encouraged to diversify into other by incorporating other strategies, so that your risk level will be mitigated as a result. Number 7, market timing risk. Growth investors tend to indulge in market timing whenever analysts predict the growth rates of a particular stock. That prediction, that analyst consensus will attract growth investors, and they will pile into the stock at a particular point in time. And that's what is called market timing. And so market timing is not always a right approach to investing in the market, because the market actually is vibrant almost at all times. So one should not just choose a particular time to enter. You could invest at any time, and so avoid market timing. You invest in the market with a long time horizon in mind. Don't just jump into a stock at a given time based on the fact that an analyst gives a consensus, or analysts give a consensus on a particular stock or on a group of stocks. Number 8, dependence on the market condition. Growth stocks actually the performance of growth stocks depends largely on the condition of the markets. If the market is doing very well, growth stocks will tend to equally do very well. And if the market takes a downtrend, growth stocks generally tend to act accordingly. And so the performance of growth stocks, unlike value stocks, are strictly, or to some extent, or to a larger extent, depends on the performance of the overall market, or the economic condition prevailing at that particular point in time. Please do like this video, click the subscribe button, and press the notification button, so that I will be encouraged to keep on bringing a content of this nature your way. Number 9, overemphasis on innovation. Generally, what used to bring growth in most of times is innovation. When a company is innovative, particularly in tech companies, that particular announcement of a particular desire to bring out or to introduce a new product into the market will attract growth investors into the stock. Sometimes these products that are being introduced to the market, sometimes they do well, and sometimes they don't perform well. In the case where those products perform very well, is the market accepts the product, then of course the growth investor can benefit from that particular growth. But if the market, if consumers rejects the product or don't accept the product the way they ought to, it will affect the stock price. The stock price will go down, and the growth investor in this instance will then stands to lose his money. And so don't just depend on the fact that a new product is being introduced to the market. The product may do well, and the product may not do well. So have that at the back of your mind, and see how you can mitigate that particular risk of the product not being accepted by the market, or under accepted by consumers. Then lastly, number 10, ignoring valuation metrics. And this is this is a key feature, or a key characteristics, or a key behavior, a key attitude of growth investors. They tend to neglect valuation metrics like earning per shares, like PE ratios, and like these metrics are completely neglected, because they just believe that the stock will keep on growing and might keep on growing as long as necessary. No, we need to consider these metrics. How is the stock doing? As it relates to this metric you're talking about, is the stock overpriced? Does it have a very high PE ratio, All these things are things that that are worth considering, or else you may end up buying an overpriced stocks, and a little bad news, a little, negative impact from the environment, from the economy, will affect your stocks. And before you understand, the stock will nosedive, and you may end up losing your hard-earned money as in the process. And so don't neglect these ratios. Consider PE ratios. Is the stock expensive? Is the stock cheap? And more importantly, you can still buy growth stocks at an affordable price. Growth at an affordable price should be, the mantra in these regards.